Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
And now to one stock that is certainly surging today. Tesla up 8.6% for a sixth consecutive day. It's the longest winning streak in about a year. This after the company reported deliveries for the second quarter that beat the average analyst estimate. Ed Ludlow's with us now. He's co-host of Bloomberg Technology on Bloomberg TV. He joins us from our San Francisco bureau. So Ed, better than feared, is that the way to describe the decline in sales year over year?
Yeah, I mean, there's a mixed response. The stock's up significantly, I think on track for its biggest jump since April. But I would say there's a range of response. There's those that look at this and say, well, it is a back-to-back sequential decline, first quarter, second quarter, in terms of a drop year on year in deliveries. So it could signal that things are not great, but they're improving from where they were in the first 3 months of the year. Or you can kind of look at it the other way, which is it's still a drop in deliveries year on year. And either you believe that delivering electric vehicles is the mainstay of Tesla's business, or you look at elsewhere and you say it's just not where Tesla's headed, and so we don't have that much concern about it.
Ed, I've been waiting all day to talk to you about this.
Hi.
Hello, Ed. So let's talk about some comments that we got from Jessica Caldwell. I know that you're familiar with her as well from Evans.com.
She's awesome.
She was basically talking about Tesla's limited lineup here. It has a pretty narrow lineup as compared to most car makers. And she said, quote, "We've seen the automaker exhaust its bag of tricks by lowering prices and increasing incentives to spur demand without much success in the U.S. market." So these numbers, they were better than feared, but where does Tesla go from here?
So Jessica Caldwell is an auto analyst that looks through the consumer lens, right? She looks at the marketplace for consumer cars. And so that is an opinion that's shared by many. You know, the Model Y at this point is several years old. They have a limited range of cars. Let's say you compare with a Volkswagen or a Toyota. Think about all of the different models that they offer and actually subplates, you know, both at the luxury end and at the base end. Tesla just doesn't do that, so that's a cause for concern. The other problem is one that Elon Musk has already talked about, that there's a lot of evidence that pure play battery electric cars are battling for the attention of consumers against hybrids. And many consumers right now, where things are difficult, interest rates super high, and many are still not convinced about the utility of an electric vehicle in their lifestyle, a hybrid's a great option. That's something Elon Musk has talked about. So that may be reflected in these numbers as well.
So, Ed, if hybrids are indeed the transitional vehicle that gets us, and I'm talking about us as a globe, to a world of EVs eventually, how long is that transition? I mean, I actually know folks who had completely electric vehicles who traded them in for hybrids.
Yeah, it's really tricky. I would say that most estimates, including like Bloomberg New Energy Finance, right, which is our in-house research arm that looks at the market for battery electric vehicles, among other things, still see a massive jump from where we are today, 2024, to the proportion of vehicles on the roads that are battery electric in 2030 and 2040. We're still heading in that direction. The market for battery electric is not shrinking, it's growing at a decelerated rate. But, you know, you think about the average American family, it's the best use case to think of. Tesla is offering financing on a brand new Tesla vehicle at 2%, which is very competitive. But for many, the product itself just doesn't work. Like if you have several kids, the only 3-row option out there right now is the Rivian R1S, which isn't selling brilliantly itself. It all comes down to household economics and what's available on the market. And hybrids have had a real resurgence in the first 6 months of this year.
Ed, we have like a minute left together, and I need to ask you about the Cybertruck. I actually saw one on the highway over the weekend, and I actually slowed down just so I could stay close to it for a little bit longer and just get a really good look. What's going on with the Cybertruck? When are we going to get numbers around that?
So we have some indicative numbers because of the recalls. You know, the Cybertruck has had some physical issues. So the regulators tell us, at least in the US, like this is how many we recalled. So you can kind of do the math on how many have been delivered, and the answer is not that many. In many ways, it's a niche product. the Tesla bulls would say, hey, you guys are wrong. The lineup's not stale. They just introduced Cybertruck. Look how wacky it is. But for many, it doesn't resonate with the average buyer of any car, let alone
that's fair to say.
I think it weighs about 1 million pounds.
Yeah.
Yeah. So, but it's a fantastic vehicle. I actually yet to drive it. I've been in close proximity, but I think that's the question, that for now it's a niche, low volume product. Hence why Tesla doesn't break it out as its own category.
All right, why don't I either go to you or you come over here and we'll test drive a Cybertruck? That sounds so
Let's do it.
fun. Yeah.
Bosses,
Elliott,
if you're listening, it's a good idea.
Hannah Elliott drove one. She loved it. It was in Bloomberg Pursuits a few months ago. She loved it.
She's really cool.
She is awesome. Hey, also awesome, Ed Ludlow, co-host of Bloomberg Technology on Bloomberg TV, joining us from San Francisco.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Jamaica could be facing up to $1 billion of damage as Hurricane Beryl churns through the Atlantic. It's the earliest ever Category 5 storm after devastating the Caribbean's Windward Islands. Beryl's breakneck intensification into a major hurricane is a grim sign for the rest of the Atlantic storm season, which is still months away from its typical peak, and the latest indication of how extreme heat driven by climate change is triggering weather disasters around the world. We got with us Bloomberg's Mark Gongloff. He's Bloomberg opinion editor who covers climate change. He's here in our Bloomberg Interactive Brokers studio. Mark, we talk a lot about how the stock market is not the economy is not the stock market, weather is not climate change is not weather, yet these things are intertwined. Yeah. Please explain.
Well, there have always been hurricanes, but the thing about this hurricane is that it is a kind of literal freak of nature that is, as you mentioned, the earliest Category 5 in history. The scary thing about it, maybe even scarier thing about it, is that it went from 0 to Category 4 in like less than 2 days, which has only happened like 6 previous times in history. And usually that happens in like September when the ocean water is really warm. And so we've got this thing where, yes, it's a hurricane. Yes, hurricanes happen, but the ocean water is like a bathtub. It's like September level hot right now. Part of that's El Nino. Again, El Ninos happen, but the combination of El Nino and human-made climate change has made ocean temperatures like almost literally off the charts hot, and so that is fueling this crazy storm.
And so, what does that mean for the rest of hurricane season? If we're starting early, maybe we'll end early, maybe not, or maybe will this just be super intense?
Unfortunately, it looks like it's going to be super intense. Before it even started, the number crunchers came up with forecasts for it that were like, again, like it was going to be a record season. 30 big storms, 7 major hurricanes, which are like Category 3 or above, and that which is more than like the usual like 3. And most of those are going to affect the U.S. in some way. This one may end up affecting like Texas, and so it's the water's going to stay hot. It's not going to get any cooler until like October, November, and then this rapid intensification thing that we're seeing is another feature that we can expect throughout this season too. Unfortunately,
one thing I think about a lot, Mark, it's not climate migration, which you've shared with us before, and the idea of moving from one country to another country as a result of what's happening in your own climate, which we're seeing right now, certainly, or as the effects of what's happening with climate, but something that's happening more local. The idea of not necessarily living in a part of the country because you're concerned about fires or hurricanes or rising insurance rates in places like California, or being dropped by your insurance in California because of fire risk, and that essentially becoming a place, for some people, that's not inhabitable because they don't want to deal with that. What happens first? Do we start to see like a reversal in what we're doing as humans to slow climate change, or do we just write off these parts of the country that get hit over and over again?
Well, apparently what happens first is everybody moves into those parts of the country really in a big way.
Okay.
Florida, Texas, Arizona, Phoenix, where it's like 120, people are like cooking on the streets, are the fastest growing places in the country. And so a lot of people are moving there because it's cheaper. it's going to stop. It's already stopping. That cheapness is already going away as they're discovering they can't maybe get a mortgage on their house, or insurance rates are skyrocketing, or they can't get insurance at all, or they have to clean up. And so what you're seeing is we're going to see maybe some gentrification of some of these areas where, if you're wealthy, you're going to buy a house on the coast, and if it gets knocked over, you're going to build it back up again. One of the things we maybe need to do is to stop sort of subsidizing that. Like, if that's what you want to do, cool, go for it. I love the beach too, but if your house keeps getting knocked down, we don't have to pay to rebuild it. And at some point, I personally think we need to work on some sort of managed migration, some sort of managed retreat from some of these areas. But the market is sort of forcing us into that right now because we're not doing the managed stuff. We're being forced to by, you can't get insurance anymore, or your house is getting knocked down, that sort of thing.
Let's talk about New Jersey.
This is so near and dear to Mark's heart.
I love to.
He loves New Jersey Transit. If you don't know this about Mark, he's got a real soft spot for New Jersey Transit.
I'm going to take you completely at face value.
Okay.
And I want to talk about New Jersey. We were talking about the commute yesterday, getting longer, costlier, and you wrote, when it comes to New Jersey Transit last week, is failing the climate test. And it feels like a lot of what we're talking about, it's very local, too.
Yeah. Well, it's local, but it's also national because, it blows my mind. Tim is being facetious about my love for New Jersey Transit, as you probably guessed. It makes me crazy. It has put 10 years on. It has taken 10 years off of my life, but it affects the entire country because there's this 10-mile stretch between Newark and Penn Station that it has these wires, these electrical wires that were built around World War II, and it's the only place in the country that has it.
It's a piece of history, Mark.
It's a piece of history, and you can look out and gaze on it when your train is sitting there doing nothing for like 3 hours while you're waiting to move.
I think Mark says it's a piece of something.
It is a piece of something, and this is a family show, I guess, so I won't say what it is. But these wires are ancient, and when it gets hot, they sag, and they get tangled up in the trains, and then all the trains shut down. And there's a bunch of other nonsense like that. There's a bridge that you have to raise and lower every time, like anything bigger than a sailboat needs to go through, and all the traffic on the eastern seaboard shuts down. It's bananas. And so they're working on that, but it's going to take a long, long time to fix it. They're talking about like 15, 16 years to fix it, which, again, in my opinion, not just as a New Jersey Transit commuter, but just as somebody who's like, this is the biggest rail line. This is also Amtrak, so it affects traffic going from D.C. to Boston. This is a major artery, and if we're going to prepare for a world in which we maybe drive less, maybe burn less fossil fuels, we need better transit, and if we just want an economy that functions, if we want productivity, we want people to come into this city and go in and out and just travel, then we need to fix this much more quickly.
I think one thing that might be frustrating to some people, Mark, is that there's a huge economic part of this too. The idea that in order for a city like New York to be an engine of economic growth for a country and for a region, there needs to be reliable transit. And we haven't seen that necessarily from the agencies.
No. We haven't, and it's a big political ask, and I understand that too. My New Jersey Transit train doesn't fill up your gas tank or put cereal in your cereal bowl. People are worried about inflation, that sort of thing. People have, but immediate economic concerns. The difficult thing, the political trick to turn here is to express to people just how much economic damage will happen if we don't fix this stuff now. If you don't invest in mitigating climate change in the next decade, the cost of doing so will double in the decades to come. And so it is a matter of, and we're just bad at this. I'm bad at this. I'm bad at saving for, retirement. I'm bad at everything, saving, thinking about the future, thinking beyond what I'm going to eat for dinner tonight. But we have to start thinking that way as a society. How can we save money in the future by spending more now?
Mark Gongloff, he's a must-read whenever he has a column out. He's Bloomberg opinion editor covering climate change, joining us here in the Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
New York's housing market facing the tightest squeeze in 5 decades, and little relief is in sight. A rental vacancy rate of just 1.4% is pushing the cost of living in New York City higher. And last month, developers filed the fewest permits in a decade to build new multifamily buildings. Experts fear it all adds up to a bleak reality for the most populous U.S. city. Soon, New York may price out all but the very wealthy. Someone who's got a front row seat to everything happening in New York City real estate is Frances Katzen. She's founder of the Katzen Team at Douglas Elliman. She's back with us here in our Bloomberg Interactive Broker studio. How are you?
I'm well. Thank you for having me.
Yeah, thanks for joining us. When Charlie was talking about the yield on the 10-year, you were like shaking your head.
Yeah.
Because certainly mortgage rates follow the 10-year. But
correct.
To be fair, a lot of your clients don't take mortgages.
Well, I mean, we just saw a huge barometer about that, right?
Yeah.
We saw the market from basically 4 million to 4.995 go down 59.2% in May, and then basically uptick to 57% in non-movement, meaning nothing's happening. Every other segment has this sort of movement, but the 10-year Treasury yield used to basically track the 30-year fix. Now we're at 7% on average. It's very stressful because the people that need that amount of borrowed leverage to get into the upper movement, and there's an opportunity to get in much less, can't make it happen. And that's the 59.3% reduction of non-trading in that segment. Nuts.
Well, when it comes to the people who are moving, I forget how many D's there are, but divorce, death, diamonds, diapers, that's another one.
Diamonds? Oh,
yeah,
for when
you
you get married?
Yeah, and then they buy a house or an apartment or whatever. The people who are still moving, specifically in New York, I mean, are they moving because they have to, or are we seeing things loosen up on that front?
Those are the only movements, and they're far and few between because most are renting. That's why you're seeing a 40.5% uptick in rental. It's the highest amount of leases signed year over year in like the 6th increase in like 7 months. Nuts. So I think some are buying, but some are priced out or simply can't get their head around a 7% versus a 2.5%.
I want to talk a little bit more about the rental market because I actually recently moved.
Congratulations.
Thanks. I moved like 2 weeks ago. I had wanted to buy a year ago. I quickly discarded that dream. And then we found this apartment, and the listing price or the price per month was just a little bit too high. So we said, we'll pay you $500 less per month. And they said, okay, great, it's yours, which I was really surprised about. I know that it's just anecdata, but what is the state of the rental market? I mean, it seems like rents are still going up, but then you hear stories like mine.
Well, you're lucky,
Thank
is what
you.
I can say, because what we're dealing with is multiple applications that
Still?
are cannibalizing. Yeah, I just did it at 450 East 83rd Street. We had 7 apps, and one is over $500 more, actually. We rented it above the ask. The concessions are still very little. There's 27.5% more inventory now on the rent side, and I suspect because people don't want to take less than what they want for a sale, so they're basically converting. I think you're the anomaly, honestly. I think there's such a tight... Look, it's a double-edged sword. It's like way overpriced rental, or who can help you get the hit to make the numbers work until there's a refi that takes place maybe at the end of the year or first quarter of next year. I don't know.
Yeah, I will say, I think we were lucky. I promise it's a nice apartment that we moved into, but...
Manhattan?
Oh yeah, Upper East Side.
Well, that's one of the segments that's sort of very interesting, actually, for opportunity.
Well, tell me more. I mean, I already signed my lease and we're moved in, but interesting in what way?
Depending on how far east you are from the west side of the east side, if that even makes sense, there's a little bit more negotiability because I think that people want to be close to their commute. So there's a little bit less desirability, and a lot of that product may be not as desirable based on post-war, lower ceiling, not particularly the main event in terms of inventory. You're competing with a lot more newer product. There seems to be a nice opportunity for family-centric need next to schools to get in on the Upper East Side.
Where are you seeing activity?
Downtown, the usual. Brooklyn, oh my gosh. On fire.
Please keep
Brooklyn's
Brooklyn
on fire,
is on
Tim.
fire.
I've been saying this for years. It's where all the cool people live.
It really is. I'm
I
feeling
think it's
very
the Upper
uncool
East
these-
Side that's popping relative to Brooklyn.
I don't know.
Please,
Brooklyn's got
Frances,
it going
continue.
on.
What's going on with Brooklyn?
It's it's exceeding price per square foot demand. People used to walk in and say, I want to look at West Village, Tribeca, and maybe Flatiron.
Now
they're
they
like,
say Cobble Hill.
They'll do
Carroll
West
Gardens.
Village and Brooklyn.
Yeah.
And they'll do Greenpoint, or they'll do, Carroll Gardens, or they'll do Williamsburg, whatever. But it's no longer this outlier. It's part of the downtown
I will
vibe.
say, walking around Williamsburg in this day and age is like
It's
walking
lit.
around the West Village. Not in terms of, or maybe Soho in terms of retail. Not in terms of the character by any means, but in terms of what retail is there. It's pretty incredible.
It's incredible. Those restaurants, the vibe, the indie feel of it, the independent nature of these stores, and in Greenpoint, it's cool. It's got it going on. And the pricing's only getting stronger.
When your lease expires, you can move to Brooklyn, Katie.
In 2 years? Absolutely not. I think I'm going to New Jersey after that. But, after the segment ends, I'll tell you exactly where I moved. But I do want to clarify. We got a deal on this apartment, but I will say when we were looking around, maybe a little bit closer to the Bloomberg office, there were bidding wars for rental apartments.
Thank you.
We toured one beautiful apartment, and then we followed up later that night over email, and they said, tell us what you would be willing to pay, because everyone who saw it today wants it.
Wait, it was like best and final?
Yes, best and final for a rental.
Yeah, that's
Wow.
what happens. That's what's happening right now on all of my product. Oh, yeah.
Yeah.
Oh, yeah.
And
Nuts.
how does this end? How do things get better?
So it's a really good question, right? It's like the chicken or the egg. I think that, so here's the dilemma. Right now, nobody is really buying at the same pace that they did in 2021 and 2022, right? So there's this inherent opportunity to get in at a wholesale price and really buy up. The big issue for most is how to tolerate that really high carry. So my advice is you don't want to be buying when everybody else is buying, because there is no inherent value to that. You're basically paying upmarket pricing based on supply and demand. So you can refi, and you can always refi. You can't refinance the purchase. And so the refi becomes the play. How long do you have to carry that higher number? And to me, that's the inherent value.
I've heard higher for longer in certain places, mainly this studio and from Jay Powell and company.
Out on the street? Is that
Out on the
what
street,
you're talking about in
much.
Brooklyn?
No, we don't talk about it in Brooklyn.
No.
That's
hey,
a dirty
Francis,
word.
before we let you go, I'm curious about where people move when they do list apartments with you. Where are they going?
Out of here.
Like
Yeah.
New Jersey, like Katie said?
Not necessarily.
Okay.
We've got people, some of it is New Jersey, some of it is Florida, some of it is going to be in Westchester. It's like they want to get out of the city. These are people who've had their run and they want to cash out. Or they're at a time in their life where they don't want to do stairs anymore. Literally big, finance players who just are like, I've got too much real estate. I want to size down, but I want to take a rental and stay near my kids in the city, but I'm going out. I'm going to go get something somewhere else.
That's interesting.
I wasn't that specific on that one
That's
because they're
okay.
all so different.
Specifically stairs, though? They don't want to go up and down the stairs?
Some. Very interesting. Yeah. We're getting to the point where we don't want to do that.
Yeah.
And they're perfectly fine, but it's like...
I feel like young parents, too, who lift strollers up and down stairs, they do that for a little while, and then they're like, I'm done.
I'm done.
It's over.
Yeah.
The townhouse is gone in
Actually,
Brooklyn.
yeah, the townhouses. They're beautiful from the outside, but in terms of practicality.
Don't leave your keys on the top floor.
Yes, yeah. Hey, Francis, always good to see you.
Really nice
Thanks,
to see you,
Thanks
Tim.
for joining
Thanks,
us. That's
Thank you.
Francis Katzen of the Katzen Team. She's the founder of the Katzen Team over at Douglas Elliman.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, we just heard the numbers from Charlie Pellett and Bill Maloney. The Dow higher by 0.4%. The S&P 500 higher by 0.5 percentage point. The NASDAQ higher by 0.7%.
You led with the Dow.
Yeah, I'm just in order.
You guys do
of the terminal.
things different over here.
No, I don't always lead with the Dow.
Yeah, I always lead with the S&P 500.
Well. That's pretty cool, Katie.
Yeah.
You're in our house now.
I start large and then I go small.
Okay.
The Russell 2000 is what I typically do.
Cool. What are your thoughts on the market today, on the trade?
You know what I'm going to say? It's pretty quiet out there.
I've actually seen volume down.
Absolutely. I mean, this time yesterday, volume was a little bit actually above average. And I think that's the last day this week that we're going to see that because things quiet down from here, theoretically.
Okay, well, let's see what Sonu Varghese has to say. Sonu's a vice president and global macro strategist at the Carson Group. Sonu, it's good to have you with us for our drive to the close. How are you?
Good. Thank you for having me. It's awesome to be on.
Thanks so much for joining us. What do you see out there beyond this week? I mean, certainly, I think it's fair to say it could be a quiet week when it comes to trading, not so quiet when it comes to economic news and Fed speakers. But as you look at the 15% rise that we've seen in the first half of the year, what does the second half portend?
I think momentum is one thing. So momentum begets momentum is like what I like to think of, how I like to think about markets. And we've had a lot of that, right? Right from Q4 of last year into Q1. We had a bit of a hurdle in April, and then things came back. I mean, one thing that's happening is the market's gone up, but it's gone up on the back of earnings too. Out of the 15% gain over the first half of the year, more than half, a little over a half, has come from earnings growth and dividends, right? So about 7 to 7.5% plus another 0.80 basis points or so has come from dividends growth. And so I think that's what's powering markets higher. And next week we start again with earnings season. One thing that's interesting is forward earnings expectations have been rising. And on the back of margins too, margins have been a big part of that. I think that's what continues to drive the market higher.
So I definitely hear what you're saying, that you think about the fundamentals, you think about the earnings picture, and it really helps justify what we're seeing at the broad benchmark level. But you think about forward earnings expectations. I mean, when do expectations just get too rosy? When does that bar just get too high and you start to see companies actually start to disappoint?
I think companies are good at playing this game, at the expectations game too, right? So as we get into earnings season, just before earnings, you can see that maybe forward expectations tamp down a little bit, and then it sort of slows down. One thing that's kind of been surprising over the last 4 weeks, really since the end of earnings season, forward expectations have actually gone up even more. So one thing I'm watching is, do companies come in and say, wait a minute, you're stretched a little too far, analysts, all of you, and maybe pull that back a little bit, right? So because at the end of the day, I think companies try to meet expectations on the earnings call on the day of the earnings. So I think they know how to play that game. So I think from that front, it'll be a gradual shift, if anything, if at all, right? We just may not see a continued ramp up in forward earnings expectations as we have seen. But I don't think they go down unless, when nominal GDP growth is running around 4.5 to 5.5%. That's a strong backdrop for earnings growth.
Okay, from earnings, I want to go to the labor market because we got JOLTS job openings, labor turnover survey results today at 10 o'clock. We actually saw that come in higher than estimated. It's a little bit of, quite a bit of strength in the labor market, not entirely Fed friendly. How are you looking at the labor market?
I think it's more, I would characterize the JOLTS report. I mean, you look at openings at the total story, the totality of openings, hires, quits, layoffs, all of it. It was a bit of actually, yes, openings went up to about just over 8 million, but otherwise it was a bit of a snoozer, wasn't it? With hires, didn't move. It moved up to 3.6%, the hiring rate. The quit rate was around 2.2% as well. Layoffs remain really low, around 1.5, 1.6 million, about 1% as a percentage of the employed workforce. So more of the same. I think one thing that we're seeing is hiring has eased a lot, right, from last year and even let alone 2 years ago. But why is net employment high? It's because separations are low. Quits are low, layoffs are low. I think, like Powell said today in Sintra, that the labor market has eased, has cooled off, but it's happening gradually, right? Mm-hmm. It's not happening suddenly. That's a good thing. So that keeps them on track. At the same time, I think they are aware, bringing the Fed back into this, they are aware of the double-sided risk, right? The risk that they don't act and the labor market weakens even more, and that becomes a snowball, an avalanche eventually. versus the risk of undoing all the gains they made on inflation so far. So
right.
I think they're aware of both sides of that.
And just one quick point on the JOLT stat. I thought it was interesting. You bring up the quits rate. It's been 2.2% for several readings in a row. So it's been interesting to watch that line pretty much do nothing. But zooming out a little bit, of course, we're talking about the labor market. We're talking about the economy. And that follows our conversation on earnings. And I'm curious from where you're sitting, what is this market responding to? Are we really just paying attention and being driven by those corporate earnings? Or is this still a Fed-driven, a macro-driven market at this point?
Between Q1 and Q2, I would say it was definitely in response to earnings, because earnings have come out so strong. Especially if you look at Q1, at the end of Q1, the S&P was up about 10%. Most of that, about 7 percentage points, came from valuations. You can think of that like sentiment, right? And 3 percentage points or thereabouts from earnings growth. Now, fast forward one more quarter, the S&P is up about 15%. More than half of it has come from earnings growth, right? So it was an earnings growth, and I should mention margins too that powered that. Now, again, not to ignore, these things are all correlated, right? It's not like earnings is happening in a vacuum and the economy is doing something else. No, the economy is also doing fine. We're seeing disinflation too. So I think markets are expecting the Fed to, drop rates on the back of those disinflationary trends, which I think the Fed probably got spooked a little bit by the Q1 data, but as Powell said today, the disinflationary trend is back on. I mean, from our perspective, I don't know if we ever got out of the disinflationary trend. It was just for various idiosyncratic reasons that Q1 inflation came in hot, but we got to follow what the Fed says, right? So.
All right. Yeah, that's really interesting. And we didn't even really get to the politics of it all. But unfortunately, I think we're going to have to leave it there. Our thanks, of course, to Sonu Varghese of the Carson Group.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.